Good day, everyone. So today is our fifth week of class for our subject, Business Finance. And now we are going to discuss another topic. So our topic for today is all about basic steps in preparing the budget. So in the basic steps in preparing the budget, of course, we are going to discuss about the budget preparation. So when you say budget preparation, it is done in a sequential manner. Leaving one of the process could be enough to result in a useless budget. So budget preparation usually takes following steps. So the first one is the projection of the firm's sales, and then the production cost, inventory level, cost of goods sold, selling and administrative expenses, cash budget, and pro forma income statement, and also the pro forma balance sheet. So when you say sales forecast, this is the process of gathering the volume of sales. So it serves as the mother of all the budget that every subsequent operating and financial budget will rely on. So the firm should be prudent in making the sales forecast as responsible and accurate as possible to be useful. Next is what we call the sales budget. So the sales budget, this refers to the planned volume that the company is expected to sell based on the forecasted sales. So the sales forecast and sales budget is just connected. So it provides a detailed plan of sales during a budget period. So it is also where the operation budget and the financial budget start. So the sales budget is prepared on a monthly, quarterly, semi-annually, or yearly basis. And then, so sa sales budget, a sales budget is computed as the expected sales in unit, and then multiply by the unit selling price, and then it's the total sales. So that's the computation. So we have here an example. So let us assume that the firm is expecting to have the following quarterly sales. So on first quarter, we have 2,000 units. Second quarter, we have 2,150 units. Third quarter, we have 2,200 units. Fourth quarter is 2,450 units. So let's also assume that further 60% of expected sales are collected in the first quarter of the sale and 40% is collected in the quarter after the sale. So the sale per unit is 100 pesos. So here is our table. So our example is the RDF merchandising. So we try to show you the sales budget. So for the year ended December 31, 2014. So the quarters, we have here the quarters. Let me show it for you. So this one, the first quarter, the second quarter, third, and also the fourth quarter. So as what I have told you a while ago, we only have two things that we're going to do to compute the sales budget. So first one is the expected sales in units. So I have already told on the last slide that the first quarter is 2,000, second, third, and also the fourth is 2,450. So when you're going to add this one, the four quarters, so the total will be, that's 8,800. So the unit sales price is that the first quarter and until fourth quarter, you just multiplied it by 100. The same with the total. So for the first quarter, we have here this one. I will use the blue one so that you can clearly see it. So the total sales here for the first quarter is 200 pesos. For the second quarter is 215,000 pesos. Third quarter, we have 220,000 pesos. And for the fourth quarter, we have 245,000 rather. So the total for all of that is 880,000, meaning the sales budget is 880,000. As simple as that. So you just have to remember the formula on how to compute the sales budget. And also, next is after the first example or first solution, we also have the schedule of expected cash collections. So as we have here, we have our account receivable of December 31, 2013. So his or her account receivable is only 20,000. And then above here is the quarters. And also beside we have also the quarters, 4 quarters, and also the total cash collections here. So on the first quarter, we have 120,000 here on the first quarter. So how did we get the 120,000? So the cash collections, here is the following computation. So we first on the problem we have to multiply the first quarters for the per quarter into 60% and 40% for a total of 100%. So si 20 bakit siya naging 200,000? So where did we get the 200,000? We get the 200,000 on the first slide that I have given to you, the total of the table for the first quarter. So that's why we have here the 200,000. So 200,000, we are going to multiply it sa 60%. So yung first quarter natin, ang kaniyang total is 120,000. Kaya ito naging 120,000 dito. Okay? The same lang din sa 40%. So 200,000 pa rin para sa first quarter na payment. So 200,000 multiplied by 40%. So that is for 80,000. So this is presented on the second quarter. So the same procedure shall be applied sa second, sa second, third, and fourth. However, sa second collection, dito, second collection until kay fourth quarter nga collection is hindi siya mag-reflect dito in the schedule of the cash collections since it will be collected on the first quarter of the next year. So meaning, yung kay second quarter dito, kay third quarter and fourth quarter, ang first payment nila is makikita na naman natin by next year, 2014. Kasi ito siya is for 2013 only. Okay. Next. So, production budget. So, when you say production budget, the budget gives an assurance that the units required to produce the sales requirement for each period are met. So, the expected volume of production is determined as follows. So, ito siya ang gamitin sa pagkuha sa expected volume of production. So, first one is we have the planned sales, and then also the additional or the desired ending inventory, the total needs, and the less beginning inventory, and also units to be produced. Okay, so we have here an example. So let's read first the problem. Assume that the ending inventory is 20% of the next quarter sales, and at the ending inventory of the fourth quarter is 500 units. So, same company, RDF Merchandising, and then sa sales budget tayo kanina ngayon, we are going to have the production management for the year ended December 31, 2014. And with the given, the budgeted sales volume, the additional desired ending inventory, the units available for sale inventory, and the required production. So, we have here 4 quarters also, the same as we had a while ago. And then, the given are 2,000, 2,150, 2,200, and 2,450. So, the problem here is that the ending inventory of the fourth quarter is 500 units. Dapat daw ang makuha. So, dito, nakuha natin si 500. Pero, we have also to make sure that yung ending inventory daw, dapat ito, dito, ang ending inventory natin is 20% of the next quarter sales. So, sa first quarter, ang 20% ni 2,000 is 400. Pero, we are not going to use that one on the first quarter. So, what will be the next ending inventory? So, we are going to have the 2,150. So, the 20% of 2,150 is 430, which is this one. So, we are going to write that one sa first quarter. The same lang kay 2,200. So, ilan yung 20% ni 2,200? That is 440. And then, the same kay 2,450. Ang kanyang 20% is 490. So, ganyan ang pagkuha kay additional desired ending inventory. Pagkatapos, dito, kay units of available for sale, how did we get this one? We are just going to add the budgeted sales volume and the additional desired ending inventory. Add lang yan siya para makuha natin siya. So, that's 2,430 for first quarter, 2,590 for the second quarter, 2,690 for third quarter, and for the fourth quarter, we have 2,950. And then, sa less beginning inventory, dito na siya. So, sa 20% ni 200, we are going to start na kay 2,000. So, sa 2,000, ang 20% niya is 400. So, here, ito na siya nakalagay. The same with the second quarter, 20% ni 2,150, 20% ni 2,200, and the 20% of 2,450. So, para makuha natin itong required production, ito siya. What we are going to do is, we are just going to subtract ang units available for sale sa kanyang less beginning inventory. So, ito na siya. Ang first quarter is 2,030. Second quarter is 2,160. Third quarter is 2,250. And for the last quarter, we have 2,460. So, if you are going to total that one, all in all, we are going to get the 8,900 for the required production. Okay. Next, the manufacturing cost. So, this is the necessary cost to produce the desired units. It is composed of the direct materials, direct labor, and factory overhead. So, the sum of the direct material and direct labor is called the prime cost, while the sum of direct labor and factory overhead is the conversion cost. So, always remember that one. Ang sum or ang total ni direct material and ni direct labor is prime cost, and then ang kay direct labor o factory overhead is conversion cost. So, si direct materials, ito yung mga obvious material na ginagamit in producing the item. Like for instance, if the product is furniture, ang direct material niya is wood. And then for the direct labor, this is the cost of labor directly associated to production. So, this is referred to as an indirect labor. So, example of indirect labor are the salary of the supervisors, the managers, and crew that provide service. And sa factory overhead, this is comprised of items that are not directly associated with the production of goods but are necessary to be incurred as part of the cost of production. So, it consists of variable factory overhead and fixed factory overhead. So, sa variable factory overhead, this is composed primarily of indirect materials and indirect labor. On the other hand, sa fixed factory overhead naman this includes the expenses such as the depreciation expense, utilities expense, and other expenses that can be classified as indirect material or indirect labor. And we have an example. So, si RDF merchandising determined that the quarterly direct materials is 20 pesos per unit. And the direct labor is 15 pesos per unit. So, si direct factory overhead is composed of variable manufacturing overhead. So, ang per unit niya is 5 pesos. And then si fixed factory overhead is 12,500 pesos. So, ang factory overhead costs are paid in the quarter in which they are incurred. Here is the problem or the solution. So, si RDF Merchandising production budget for the year ended December 31, 2014. So, we have here the units to be produced, direct material at 20 pesos per unit, direct labor cost at 15 pesos per unit, the total prime cost, the factory overhead, and the total direct labor cost. And we also have the supporting schedule of manufacturing overhead, budget variable factory overhead, and the budgeted fixed factory overhead. So again, 4 quarters. We have also 4 quarters. And the units to be produced now is 2,030, 2,160, 2,250, and 2,460. So, si direct materials, pag 20 pesos ang per unit niya, is 40,600, 43,000, and so on. The same with the labor, total prime cost. So, this is the picture of the production budget for the RDF merchandising given the problem on the next slides. So, next is the selling and the administrative expense budget. So, the selling and administrative expense budget lists the overall budgeted operating expenses in areas other than those included in manufacturing. So, example, si variable selling and administrative expenses of RDF merchandising amounts to 6 pesos per units of sales, including na si sales commission, office supplies. So, ang fixed selling and administrative expense amount to 20,000 per unit per quarter. So, ang expenses are paid in the same quarter in which they are incurred. So, we have here the problem. This one. So, budgeted sales volume is this one. The same lang sa given kanina. And then, ang variable selling administrative expense rate per unit is 6 pesos. Ito. And then, ang budgeted variable selling and administrative expenses is 12,000, 12,900, and so on. And then, the fixed selling administrative expense is 20,000. So, ang budgeted selling and administrative expenses is just, you are going to add the budgeted variable selling and administrative expense and the fixed selling administrative expense para makuha si budgeted selling and administrative expense. Next one is the cash budget. The cash budget is one of the most important and critical ingredients in financial planning. So the cash budget is composed of 4 major sections. The first section is the cash receipts section. This is the list of all the cash inflows except for financing during the covered period of the budget. The second one is the cash payments section. This consists of all cash outflows included in the budget period. So cash payments to be included are direct materials purchases, direct labor, factory overhead, and other cash payments included in the budget preparation. The third is the cash surplus or deficit section. Simply shows the difference between the cash receipt sections and the payments section. So this section indicates if the firm needs to borrow funds to support the operations of the company or use the excess money to pay their obligations or invest in the other profitable activities. And then the last one is the financing sections. This shows the borrowings and payments made by the company. Say for example, to prepare the cash of RDF merchandising further assume that the following information, these are the cash balance at the beginning of the first quarter is 10,000 pesos. The management desires to maintain a 50,000 pesos minimum cash balance at the end of each quarter. And that the RDF merchandising has credit line with RCBC that enables them to borrow at an interest rate of 12% per year. All borrowings and repayments are in multiples of 1,500 pesos. So all borrowings take place at the beginning and repayments the quarter. And then fourth, equipment amounting to 25,000 pesos will be acquired on the third quarter. The board of directors approved a cash dividend of 2,500 per quarter. The income tax payable amounting to 16,000 pesos was paid on March 2014, and at the end of the year, any amount in excess of 50,000 pesos are invested in treasury bills. Here is the example or the solution of the problem given a while ago. Next is the budgeted income statement. So from the various budget prepared, the pro forma income statement can now summarize the various components of planned revenue and expenses for the budgeting period. So it serves as a control device in measuring the firm's performance by comparing the actual outcome to its budgeted figures. This is an example of a pro forma income statement. Next is the budgeted balance sheet. So the budgeted sheet is developed by using the previous year's actual balance sheet. So all the accounts entered in the balance sheet are real accounts and are used to carry forward the remaining balances. And here is the example. So assume that the previous year's balance sheet of RDF merchandising has the following balances. And so the illustrated balances are used as the starting point with adjustments to be affected in the pro forma balance sheet. So the changes in the accounts together with the source budget or schedules are as follows. So here, the balance amounting to 10,000 pesos appears in the cash budget. So si cash beginning balance, si additional, si total cash available, si less expected cash payments, cash surplus, and then the last interest expense on financing, investments, and then budgeted cash or the ending cash. So, ang cash beginning balance niya is 10,000. Tapos, yung additional expected cash receipts niya is 802,000. So, ang total cash available niya ngayon is 812,000. And then yung expected cash payments is 539,800. And then yung cash surplus na kanina is 272,200. So ang interest expense financing niya is 1,902. And then yung investment niya is 220,000. So ang budgeted cash and ending balance niya is ito. Okay. Here is the continuation. So accounts receivable. The accounts receivable for December 31, 2013 is 20,000 pesos. So, ang additional planned sales from sales budget is 880,000. So, ang total niya is 900,000. Expected cash collections is 802. So, pag isubtract natin ang total at saka yung less, this one, that we are going to subtract that one, the budgeted amount, budgeted accounts receivable for December 31, 2014 is only 98,000. So, merchandise inventory. So, the 500 units multiplied by 40 pesos, that's 20,000. So, for land, no acquisition made in 2014, so it's 80,000. And then the building equipment of December 31, 2013 is 150,000. So, ang additional equipment to be acquired in the third quarter is 25,000. So, ang kanyang budgeted building and equipment sa December 31, 2014 is 175,000 sa total ni building and equipment and additional equipment to be acquired. So, accounts payable. So, accounts payable of December 31, 2013 is 3,300. And then yung additional planned purchase niya is 1,078,000. So, ang total niyang accounts payable is, total tong dalawa, we are going to get 181,300. And then yung less niya is 178,000. The same lang sa kanyang planned purchase. So, ang budgeted accounts payable niya is only 3,300. So, subtract tong dalawa. Next, the income tax, the common stock, then the retained earnings. Here, so this is the pro forma balance sheet will appear. Ito nang itsura niya. So the other budgets, aside from those budgets mentioned above, the firm can prepare other possible budgets. Two of them are the pro forma cash flow statement and the budgeted financial ratios. Here, another example, and the budgeted financial ratios. And so, that could be all for our lesson for today. And we are going to continue our lesson next week. And just please answer the activities given to you on your LMS. That could be all. Thank you and goodbye.